90%. That's the percentage of retail traders who lose money. Some studies put it even higher, 95%. And the ones who do lose? Most of them blow up their accounts within the first 12 months. Think about that for a second. You could be smarter than average. You could study charts every single day. You could have a solid strategy. And statistically, you'd still probably lose. So what's going wrong? Today, we're going to break down exactly why the vast majority of traders fail, and more importantly, what the 10% who win are doing differently. Because I promise you, it's not what you think. Stay with me. This video might just save your account.
Trading looks simple from the outside. You buy when the price goes up, you sell when it goes down, you make money. Repeat. Except it doesn't work like that, and the market doesn't care how smart you are. The brutal truth is that trading is one of the only industries where the beginner competes directly against professionals who have decades of experience, institutional-grade tools, and entire teams of analysts working for them on day one. You're essentially stepping into the ring with a heavyweight champion your very first day on the job. But here's what nobody tells you. Most traders don't lose because the market is rigged against them. They lose because of themselves. Their psychology, their habits, their misconceptions about what trading actually is. In this video, we're going to go through the 5 core reasons traders lose. And I'm going to give you a framework at the end that you can start applying immediately. Whether you're just starting out or you've already taken some painful losses, this is the honest education most people never get. Let's get into it.
Let me ask you something. Before you placed your last trade, did you have a proven reason to believe that trade would be profitable over time? Not a feeling. Let me ask you something. Before you placed your last trade, did you have a proven reason to believe that trade would be profitable over time? Not a feeling, not a hunch, not because you saw someone post about it on social media. An actual tested edge. Most traders don't. An edge in trading simply means when you apply your strategy across hundreds of trades, the math works in your favor. Think of it like a casino. The house doesn't win every hand, but it wins enough because the odds are slightly in its favor on every single game. The average retail trader does the opposite. They see a stock moving. They feel excitement. They jump in. That's not a strategy. That's gambling with extra steps. Here's what a real edge looks like. A trader might notice that a specific pattern on the daily chart, combined with a particular market condition, produces a winning trade 55% of the time, with an average gain of 2% and an average loss of 1%. Do the math on that over 100 trades? It's genuinely profitable. But finding that edge takes testing, data, and patience. And most new traders skip that work entirely. They go straight to live trading with real money and wonder why it falls apart. The lesson? If you can't explain your edge in 2 sentences, you don't have one yet.
This is the big one. The reason that silently destroys more accounts than any other. Picture this. You enter a trade. It goes against you. Down 3%. Your stomach tightens. You tell yourself, it'll come back. It drops another 2%. Now you're uncomfortable. You move your stop loss. You give it more room. It drops again. Now you're in full denial mode. You're averaging down. You're all in on a position that's collapsing around you. Sound familiar? This is called loss aversion, and it's hardwired into your brain. Studies by behavioral economists Daniel Kahneman and Amos Tversky showed that the pain of losing $100 feels roughly twice as powerful as the pleasure of gaining $100. Your brain is literally designed to avoid losses at all costs. And the market weaponizes that against you every single day. Then there's the flip side, greed. You're up 4% on a trade. Your target was 3%, but you think it's going higher. You hold. It reverses. You give back everything and exit at break even, or worse, at a loss. Fear and greed. They're the 2 predators that eat traders alive. The professionals aren't emotionless. They just have systems that make decisions for them before emotions get a chance to interfere. Predefined entries, predefined exits, predefined position sizes. The decision is made before the trade, not during it. Here's the math that most people never look at. If you lose 50% of your account, you need a 100% gain just to break even. That's not a typo. Lose half, and you need to double the remaining money just to get back to where you started. This is why risk management isn't a boring side topic. It's the entire game. The professional rule of thumb? Risk no more than 1 to 2% of your total account on any single trade. That means if you have a $10,000 account, you're risking $100 to $200 per trade. That's it. New traders laugh at that. I'll never make real money risking $100. But here's what that mindset misses. At 1% risk per trade, you could lose 20 trades in a row and still have 82% of your account intact. You live to fight another day. You keep learning. The trader who bets 10% per trade, after 10 consecutive losses, which absolutely happens even to good strategies, they have 35% of their account left. Psychologically destroyed, financially crippled. Small risk, survive. Big risk, disappear. One more tool every trader needs, the stop loss. And not the kind you move when it gets uncomfortable. A stop loss is a commitment, a contract you make with yourself before the trade. Once it's set, it doesn't move.
More trades equal more money, right? Wrong. This misconception kills accounts quietly and consistently. Overtrading usually comes from boredom, from the need to feel active, or from trying to recover losses quickly, which is one of the most dangerous mental states a trader can be in. There's even a name for it: revenge trading. You take a loss, you feel angry, you immediately jump back in to make it back. Now you're trading emotionally, not strategically, and you usually make it worse. The best traders are selective. They wait for high probability setups and sit out everything else. There are days, sometimes weeks, where a disciplined trader does nothing because the market isn't offering the conditions they need. Think of it like a sniper versus a soldier spraying bullets everywhere. One takes one carefully placed shot. The other empties the magazine and hopes something hits. Quality over quantity, every time. The Lamborghinis, the laptop on the beach lifestyle, the screenshots of $50,000 days, and behind all of it, someone selling a $997 course promising to turn you into a full-time trader in 30 days. Here's reality. The world's best hedge funds target 20 to 30% annual returns. Warren Buffett has averaged roughly 20% per year over his career, and he's considered the greatest investor alive. So when a new trader expects to double their account in a month, the math says they're either going to take enormous risks to attempt it and blow up, or they're going to feel like a failure when they only make 5%. The traders who win long-term recalibrate their expectations early. They focus on consistency, on not losing money first and making money second. They measure success in percentages, not dollars. They think in years, not days. Patience is not a personality trait. In trading, it's a skill, and one that pays.
So let's bring this together. Here are the 5 biggest mistakes losing traders make, and they almost all share one theme. Mistake number 1, trading without a tested strategy. Jumping in based on tips, trends, or emotion rather than a proven edge. Mistake number 2, not using stop losses, or setting them and then moving them when the trade goes against you. Mistake number 3, risking too much per trade. Treating trading like a lottery ticket instead of a long-term probability game. Mistake number 4, chasing losses. Trying to get it back leads to the worst decisions a trader can make. Mistake number 5, quitting too early or never quitting a bad approach. Some traders give up right before things click. Others keep repeating the same mistakes for years without changing. The common thread? A lack of process and a lack of self-awareness. The market doesn't beat most traders. Most traders beat themselves.
All right, here's the system. 5 steps you can start applying right now. Step 1. Build and test your strategy before using real money. Use a demo account or backtesting tools. Run your strategy over at least 50 to 100 historical setups. If the results don't show a clear edge, go back and refine before you risk a single dollar. Step 2. Define your risk per trade before you enter. Pick a number between 0.5% and 2% of your account. That's your maximum loss on any single trade. Set your stop loss to enforce that number. No exceptions. Step 3. Keep a trading journal. After every trade, win or lose, write down why you entered, what happened, and what you could improve. This is the single most underused habit of consistently profitable traders. Your journal is your data. It shows you where your edge actually lives. Step 4. Set a daily loss limit. If you lose more than 2 to 3% of your account in a single day, you stop trading completely. Close the platform. The market will be there tomorrow. This rule protects you from revenge trading and emotional spirals. Finally, step 5. Think in statistics, not individual trades. No strategy wins every trade, ever. Expect losing streaks. Plan for them. Judge your performance over 50 to 100 trades, not 5. This mindset shift alone separates professionals from amateurs. Follow this framework consistently, and you are already operating better than 80% of retail traders before you've even made your first live trade.
Let's land this. 90% of traders lose, but it's not because trading is impossible. It's because most people show up without an edge, let emotions drive their decisions, ignore risk, overtrade, and expect results that defy math. The 10% who win, they're not smarter, they're not luckier. They're more disciplined. They have a process. They manage their risk obsessively. They trade less and think more. They treat every loss as data, not disaster. The market is one of the most level playing fields on earth if you approach it the right way. A trader with a $5,000 account and a real edge will outperform a trader with $500,000 and no process every time. You now know what most people learned the hard way after years of painful losses. The question is, what you do with it.
If this video gave you a new perspective on trading, hit that like button. It genuinely helps this channel reach more people who need to hear this before they make expensive mistakes.